Hello and welcome to this Magellan update. I'm Nicole Morell, Key Account Manager in Queensland, and today I have Ben McVicar and Ofer Karliner, two of our infrastructure portfolio managers with me today. Today we're going to be discussing the issues that are facing the infrastructure sector as well as the opportunities ahead. So I might kick off with a question for you first, Ben. One of the big themes in the economy is the rising interest rates, rising living costs, and the pressure that this is putting on household budgets. Are you seeing any sign of governments pushing back on price increases from companies in the infrastructure sector?
So certainly this is one of the big themes we've seen in global markets, global economies in recent years has been both rapidly increase in prices as well as really strong interest rate responses to that. What that has meant is very often consumers and households who are least able to deal with this often are dealing with what is a rapidly rising cost of living. So how does this impact infrastructure? Well, ultimately, think about the nature of what infrastructure is, what we're doing. It's about delivering essential services to consumers. And so I should add, this is exactly why we're in this space. The provision of essential services makes for a great investment because this is really where we can get reliability of demand. When you've got selling essential services, people need this day in, day out. The other factor as well is these are monopoly businesses, often near monopoly type businesses. So really reliable investment. And so the way that governments often deal with this sort of monopoly power is by price regulating these businesses. So if you think about toll roads, often what they do is they have a price path that's defined in a contract. So I think in France, for as an example, you've got a CPI times 70% uplift to prices each year. Electric utilities, very common in the US to pass through the cost of electricity generation, so you don't have to bear that inflationary pressure. So overall, that can still work as a solid investment. The risk you face in all of this as investors is that in a period of rising prices, obviously there's the risk that the governments decide to politicize this process. And that creates risk as investors. So the thing that we're seeing at the moment as an example, we are seeing some of this starting to occur. In France at the moment, what we're seeing is press reports that the government there is looking to create effectively a new tax that they're going to apply to the motorways there. Now, what is interesting here is they're looking to potentially try to sidestep the way the contracts are written. And in order to do that, what they're going to do is potentially tax all of the concessions in the market, so rather than just a specific tax, which is not allowed in that country. So that's obviously a risk. And by the way, when we've done the analysis on that, it looks like it's pretty minor in terms of the impact on valuation, but obviously it's a net negative in terms of the trajectory. But what is interesting here is I think it's what the government's not doing. They're not trying to tear up the contracts. They're not trying to rewrite the contracts unilaterally. They're working within the contracts to find ways to increase this tax. This is a common thematic. So we've seen the same thing in New South Wales, the Labor government here with their toll pricing policies. Certainly acknowledged and respected existing contracts that were in place. And going all the way back to your initial question around the ability to increase prices as per these contracts, globally we're seeing this is very consistently being allowed by governments. So we're not seeing that pressure because of the way we invest, focusing on those really high quality jurisdictions.
All right, well, let's change gears a little here and move to the topic of electric vehicles. And this one's for you, Ofer. What would a global shift to electric vehicles look like? And I guess the bigger question is, how would the current system cope, if at all?
Yeah, in very basic terms, the system couldn't cope right now with a shift to electric vehicles. It's a multifaceted problem, so you have a number of things we need to solve to get there. The generation has to increase significantly, the grid, so transmission distribution has to be significantly enhanced, and charging infrastructure needs to be in place. Now, there's not a lot of good data on what this is going to cost in isolation for electric vehicles to 2050. It's more about the whole transition costs, but there's some really good data to 2030 that gives you kind of an idea, and it's quite instructive of the quantum of the changes that need to be made. So the IEA, International Energy Agency, estimates that about 30 million electric vehicles now on the roads. They expect that to be between 240 and 250 million by 2030. That's out of a global car fleet currently of 1.45 billion. So IRENA, the International Renewable Energy Agency, estimates that at a 20-25% penetration, we need 37 million public chargers for recharging cars. At the end of last year, there were 2.2 million. That's not including the $250 million private chargers that need to be built. And they estimate that alone will cost between 900 billion and 2.2 trillion just to get to 25% penetration. So again, quite a big number. We then get to the generation and grid piece. Well, there's an Australian government report from 2021 that looked at their high case scenario of 20-25% penetration again of electric vehicles by 2030. In that case, they estimate about a 3 to 4% increase in total electricity demand, which in and of itself doesn't sound like a lot, and it's not really a problem. The problem becomes that people get home from work around the same time and plug in their cars all around the same time. They estimate it could lead to a doubling of peak demand. And so when you're building a grid, all those components need to be built for that peak load. So generation has to double. The transmission system needs to be reliable enough to cope with that additional electricity. The grid needs to be enhanced, not just for the amount of electricity, potentially for two-way flows. So at 20 to 25%, you're looking at 4 to 5 times scaling up to 100%. Not quite that simple because cars could use home batteries and you could be selling your power back to the grid. But even then, you have to upgrade the grid systems to deal with that. So globally, there's tens of trillions of dollars need to be spent. And so one of the reasons we really like electric utilities is this really long-lived theme of growth. It's a really low-risk way to play what is a multi-decade story of growth. And we just think it's not reflected in the share prices of a lot of these companies.
So the shift to electric vehicles and electrification more broadly is one theme that is obviously of interest to you as infrastructure investors. Ben, can you step us through the key themes that are running through the infrastructure strategies currently, where you're investing and sort of what interests you about those?
Yeah, certainly. So one is obviously the thing we just pointed out, which is that this net zero transition creates a lot of investment required in the utility sector. And Ofer to spend a bit of time talking about the impacts from electric vehicles. Now broaden your thinking on that topic to think about what do we want to take gas powered or gas heating, electrify that. What do we want to take some industrial loads and electrify that? And you can start to see how this multiplies out to be just a huge load that gets put on the grid. And so when we think about the portfolio as it stands today, this is one of the themes that we really like. The utilities stand to benefit significantly. Electric utilities in particular, these are regulated businesses. Historically, you'd be looking at these things as a low growth but very reliable return. The nice thing now is they're very reliable returns, but we're starting to see the growth rates and the guidance from companies in recent years looking like a sustained 5, 6, 7% per annum EPS. It's not going to shoot the lights out in a year, but it does add up over time. And the nice thing is about this investment opportunities that really drives their business for the decades to come. And so that's a significant part of the portfolio. Over a third or around a third of the portfolio is invested against sort of assets with significant exposure to electricity. One of the other thematics, if you want to call it that we like at the moment is really around the toll road space. So toll roads represent around a quarter of the strategy. The thing that's quite attractive about these assets is number one, there's a valuation opportunity that we see. The next piece that's quite interesting is obviously, like a lot of transport assets, there's really been a catch up coming out of the COVID era as they sort of get back to those 2019 levels of traffic. And most motorways we look at, you're kind of back at that level of traffic. And so a couple of examples in that space, we like a company called Vinci in France. They have a demonstrable portfolio of toll roads in France. They also have a very large airport platform. Another company, Ferrovial, who's a European-based management team, but they're primarily a North American business these days. Some really nice toll roads in that market. A really particularly attractive one in Toronto in Canada, which is a really, really nice long-lived asset in that market. So it gives you a sense. And the other thing as well, obviously, they're really inflation-protected type assets. The last piece that sort of fits into with that general situation is airports. And airports, again, the recovery's gaining ahead of steam, and they're representing just under 10% of the portfolio.
So let's now move across to transport infrastructure and airports and toll roads more specifically. So this one's for you, Ofer, where it obviously appears there's no shortage of people travelling around the world. I'm sure almost half of Australia is currently in Europe or in Bali on holidays. But the $1 million question is how sustainable is this demand, given what we talked about at the beginning, which is around the cost of living pressures and the pressure on household budgets?
Yeah, So first of all, we need to look at the data we're looking at the moment is largely COVID affected, so it's not as clean as we'd like normally. But even so, what we can generally see is, toll road demand is very sustainable even in the face of price rises. Particularly urban toll roads have been very resilient to changes in economic circumstances, changes in prices as well. So if you think about what a toll road is, it's available capacity in a road to a point. Generally they're built because there's either no competing road, you're building a new pathway, or the competing road's full. So if prices go up, one of the great things about toll roads is elasticity of demand is very, very low. So you push up prices, demand doesn't really drop off because there's nowhere to go, really. If you strip out COVID, probably the one market we can look at is pretty clean is Brisbane. So they weren't really COVID affected. In 2022 was sort of 3.5% or 3.3% above 2019 levels for financial year 22 for Transurban. Now, stripping out Airport Link, which obviously was affected, they increased prices 6% on July 1 last year. Traffic's up 9.5%, excluding Airport Link, in the 9 months to March. So clearly no real impact from rising prices there. And as long as people have jobs and places to go, again, a small proportion of total trips relate to people travelling to and from work, then the demand's still going to be there for toll roads. On the airport side, we've seen price increases come through at the airports, but they're a pretty small proportion of the total ticket price for a traveller. The biggest issue has been the pricing from airlines themselves, and that's a result of a shortage of capacity. So airlines parked or retired a lot of their planes during COVID. And manufacturers slowed down production. And speaking to some airline executives, we're about 2,000 planes behind where we would have been had COVID not occurred, so quite a lot. And there's been a big delay in actually getting those planes back into service. So Lufthansa is a really good example. They announced during COVID they're retiring their entire A380 fleet. In late June 22, they announced they'll bring the A380s back because of surging demand. Their first one went back into service on June 1st this year. So it took 11 months to get it back in service. So every airport hangar in the world that does maintenance right now is full with a big backlog. So the main constraining factor of demand is airline capacity, the number of planes in the sky. People want to travel. People have had that taken away from them for a couple of years because of COVID. So even in the face of rising prices, historically we've seen pretty exponential growth in airline travel, so about 3.5% per annum over the last few years. It means we probably should be at 10% above 2019 levels right now. We're about 10% below based on IATA numbers at the end of April. So there's probably a 20% shortfall. Now that will probably be a bit lower because there's some shift to online meetings, etc. But even so, there's still a big deficit there. So if you have a main constraining factor of actually aircraft capacity, and that's being sold over the next few years, well, that'll mean demand continues to grow with that. On the other side, what we're seeing from consumers is there's a number of surveys coming out of Europe which say that the one area of discretionary spending that's not being cut is travel. So people want to travel. What they're doing is trading down their holidays. Instead of flying to an expensive destination, they're flying to Spain or to Portugal or Greece in Europe. So we really benefit from that in the portfolio. So we own AENA, which owns all the airports in Spain. It's a trade down holiday destination. So in 2019, 57% of their travellers travelled on low cost carriers. Again, if people are trying to save money, where they're going to go? They're going to Spain, low cost destination, low cost flights. Portugal, Vinci owns ANA concession, which again, low cost destination, and they're about 13% ahead of 2019 levels of traffic already. So will we see an impact from recession? Yes. Will be pretty muted this time, probably, particularly in the airports we invest in, because effectively we expect them to be far more resilient given the nature of traffic that we see at those airports and given the demand profile we're seeing from underlying travellers.
Well, thanks, Ben and Ofer. There's certainly some interesting themes running through the portfolio and some great opportunities in the infrastructure sector. And thank you to you for joining us today and watching this video. We hope you found it insightful and interesting. You can also go to our website for some additional resources and our investor letters, which are coming out soon. Thank you and have a great day.